In 1929, the stock market crashed, leading to the Great Depression. Stocks fell 89% over 3 years. Unemployment hit 25%. It took 25 years for the market to recover those losses. In 2008, the housing market crashed, triggering the Great Recession. Stocks fell 57% in 18 months. Banks were rescued with massive bailouts. It took 5 years for markets to recover. We look back at these moments and promise ourselves that the lessons were learned. We assure ourselves that the system is now safer, smarter, and stronger. But history is rarely so kind. Today, we stand at the edge of a correction that financial historians are calling the everything bubble. This time, stocks, bonds, and real estate are all crashing simultaneously. And when everything collapses together, there is literally nowhere to hide. What if I told you we are not in a new era of stability, but in 1928, right before the Great Depression, only this time the debt is larger and the emergency tools are gone? This isn't speculation, this is arithmetic. We are going to show you why every major financial indicator is flashing red, why the crash window is now, and why the coming collapse will destroy more wealth than any event in recent human history. To understand why 2025 is fundamentally different from every previous crash, you must first grasp that the core issue is not one bubble, but 3 simultaneous, interconnected bubbles that have never occurred together in modern financial history. Bubble 1, the stock market bubble, echoes of 1929 and 2000. Start with the stock market. The S&P 500 is trading at a price-to-earnings ratio of approximately 28. This is nearly double the historical average of 15 to 17. This level of overvaluation has only been recorded twice before in history, in 1929, right before the Great Depression, and in 2000, right before the dot-com crash that vaporized 78% of the Nasdaq's value. Both times, the market collapsed within months of hitting these extremes. But today, the concentration risk is even more dangerous than those prior periods. 7 stocks, known as the Magnificent Seven, Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla, represent approximately 30% of the entire S&P 500's total market value. If these few giants crash, they have the gravitational pull to take the entire market down with them. This concentration mirrors 1929, when a handful of powerful industrial stocks propped up the entire market right before its collapse. The narrative fueling this extreme valuation is the same delusion of the past, the belief that this time is different. In 1929, the revolutionary technologies were electricity, radio, and the automobile. Today, it is artificial intelligence, or AI. We are repeating the catastrophic mistake of confusing a real, long-term technological impact with unsustainable, short-term stock valuations. Bubble 2, the real estate bubble, worse than 2008. The second bubble is real estate, and it is demonstrably more overvalued than the 2008 housing bubble that nearly destroyed the global financial system. At its peak in 2008, home prices were approximately 35% above their long-term historical trend relative to income and rent. Today, home prices are approximately 50% above that historical trend. This means the current housing bubble is 43% larger than the one that caused the Great Recession. Most people have failed to recognize the danger because prices have been high for so long that the overvaluation simply feels normal. Moreover, the commercial real estate sector is in free fall, creating a slow-motion catastrophe that will accelerate through 2025 and 2026. Office buildings are reporting vacancy rates as high as 45%.
These properties were financed with mortgages when interest rates were around 3%. Now those loans are coming due and must be refinanced at interest rates of 7 to 9%. The math no longer works. These properties are not worth enough to support triple the debt service, leading to widespread defaults and cascading bank losses, mirroring the subprime crisis of 2008, but in commercial properties instead of residential ones. Bubble 3, the bond market bubble, the vanishing safe haven. The third and most unprecedented bubble involves the bond market. Government bonds are traditionally the safe asset to which investors flee when stocks crash, as happened in 1929 and 2008. But in 2025, bonds are crashing alongside stocks. This is because the U.S. government has issued so much debt that the bond market can no longer absorb it without distress. Total federal debt exceeds $36 trillion, which is approximately 125% of GDP. Annual interest payments alone are now running at $1.2 trillion, making it the largest budget item. When faced with this crushing reality, the government has no good options. They must either default, raise taxes drastically, or print money to cause inflation. All three paths lead inevitably to an economic crisis. For the first time, there is no safe haven.
The parallels between 2025 and 1929 are hauntingly precise. In both eras, stock valuations were at extremes. Leverage was rampant, margin debt then, hidden derivatives and options today, and wealth inequality reached dangerous levels. The top 1% today controls approximately 32% of total wealth, an even higher concentration than the 25% seen at the peak of 1929. When this concentrated wealth stops spending because their portfolios collapse, consumer demand disappears, triggering a full economic failure. However, 2025 carries a far greater systemic danger than 1929: mass exposure. 1929 insulation. In 1929, only about 10% of American households owned stocks. The stock market crash was initially a problem for the wealthy speculators. The rest of the population suffered later through deflation and unemployment. 2025 universal pain. In 2025, approximately 58% of American households own stocks, primarily through retirement accounts like 401ks and IRAs. This means that when the market crashes by the projected 65% to 80%, it instantly and directly destroys the retirement savings of more than half the country. There is no insulation, no buffer. Everyone suffers immediately. The banking sector also faces a unique crisis. While FDIC insurance exists, the fund currently holds only about $125 billion, while insuring approximately $10 trillion in deposits. If the cascading failures in commercial real estate and the recession cause multiple large regional banks to fail simultaneously, the FDIC fund would be instantly insufficient. The government would then face a choice: either let depositors lose their savings or print trillions to cover deposits, thereby destroying the currency through inflation. History shows the system always chooses to save the banks, forcing the public to accept the consequences, either loss of savings or loss of purchasing power. The crisis of 2008 was survivable because the Federal Reserve and the government had powerful, unused tools. The 2025 crash will be worse because those tools are now exhausted. The loss of monetary ammunition. 1. Interest rates. In 2008, interest rates stood at 5.25% when the crisis hit, giving the Fed ample room to cut rates dramatically to zero to stabilize markets and flood the economy with liquidity. In 2025, rates have already been raised painfully to fight the post-COVID inflation surge, the worst in 40 years. If the Fed cuts rates dramatically now, they risk instantly reigniting inflation, which remains elevated. They are trapped between crashing the economy by keeping rates high and destroying the currency by cutting them. 2. Quantitative easing, or QE. In 2008, the Fed could launch QE, expanding its balance sheet from $800 billion to $4 trillion. In 2025, the balance sheet is already over $7 trillion. The Fed can print more money, but after the severe inflation of 2021 to 2023, everyone now understands that printing trillions causes inflation. The tools that worked once have been overused, and the public is fully aware of the inflationary consequences. 3. Bailout capacity. In 2008, government debt was manageable at 67% of GDP, allowing the government to borrow hundreds of billions for bailouts. Today, with debt at 125% of GDP and interest payments consuming the largest portion of the budget, the option to fund another trillion-dollar bailout simply does not exist. The system is now running on borrowed confidence. In a debt-fueled economy, confidence is the only glue. When that confidence cracks, the financial system, built on complexity, leverage, and digital speed, will suffer a systemic breakdown that is faster and more violent than anything seen before.
The historical patterns preceding a crash are always visible to those who choose to look. Today, the signals are overwhelming. 1. The inverted yield curve. This metric, which has predicted every recession since 1950 with zero false positives, uninverted in September 2024 after remaining inverted for 27 months. History shows that the recession typically begins 3 to 12 months after this uninversion. This puts the critical crash window squarely in late 2025 to mid-2026. 2. The Buffett indicator. Warren Buffett, the most successful investor in history, is currently hoarding over $325 billion in cash. His preferred valuation metric, which compares the total stock market value to GDP, currently sits at 185%, far above the 120% level he deems dangerously overvalued. The world's best investor is sitting in cash, waiting for the inevitable. Insider selling. Corporate executives who possess non-public knowledge of their company's health are selling shares at a record pace. Jeff Bezos sold over $13 billion in Amazon stock. Mark Zuckerberg sold billions in Meta stock. This mass exodus signals that the insiders do not believe the current valuations are sustainable. Consumer debt. Credit card debt has hit a record high of $1.14 trillion, with delinquencies rising. Auto loan delinquencies are the highest since 2009. Subprime lending, loans to people who cannot afford them, is now widespread across credit cards, auto loans, and student debt. The trigger could be anything: a commercial mortgage default, an earnings miss by a Magnificent Seven company like Nvidia, or a political crisis. Once confidence cracks, the margin calls will cascade, forcing automated selling and ensuring a rapid, relentless spiral. The endgame forecast. The consequences of the everything bubble are forecast to be historic. Stocks drop 65 to 80% from peak. Bonds drop 35 to 50%, an unprecedented collapse of the supposed safe haven. Real estate drop 40 to 60%. Unemployment is projected to exceed 15%. Recovery? Not 5 years like 2008, but potentially 10 to 20 years or more, mirroring Japan's lost decade. For the average citizen, this crash will be more than financial. It will be a psychological and social trauma. The psychological impact of watching everything saved disappear will be profound, and the resulting economic scarring will be deep and long-lasting. The most brutal truth of all financial collapses is that they follow a pattern. They are not random events, but the inevitable outcomes of a system where arithmetic is ignored and overconfidence is rewarded. When the system breaks, power concentrates, and wealth is transferred upward. The only choice you have now is whether you face this inevitable correction blind or prepared. History does not repeat, but it rhymes, and the rhyme of the everything bubble is the loudest warning we have heard in a century. It is a reminder that the system is not built to save you when things go wrong. It is built to survive, often at your expense.